Well, sticking with that oil spill, my next guest owns Transocean stock and says the company will weather this disaster just fine. He is Robert Hagstrom with Legg Capital Management, where he manages $3 billion. Robert, always good to see you. Thanks for joining us. And
Betty, nice to see you. Thanks for having me.
Well, before we get to the broader markets, let's focus in on Rig, because you're perfectly confident with this company despite this disaster, while others like Tom Marsico have completely sold out of Rig.
Yes. Well, let me start off by saying that Rig we've owned for quite some time. It's about a 2% position in our portfolio. Tom did the right thing. He kind of shot first, asked questions later. So anybody that sold the stock the day after the tragedy is looking better today. I think what we're challenged to do is think about it each and every day. So today the question becomes to both me and Tom is, what do you think Transocean's worth? Do you think today it's a good time to buy the stock?
And Robert, it's John Erlichman, Transocean versus the other. Hi there. Versus the other players out there, right? Because Transocean will try to make the case to investors, but you've got names that are not associated with the BP story, like Diamond Offshore, which have seen similar sell-offs and are saying, hey, we're not associated, our stock sold off. Isn't it very tough for Transocean to make the case to investors?
Well, we are, but despite, and the tragedy in the Gulf is just heart-wrenching, there's no doubt about it, but we're big believers in deepwater drilling. We think that if you think about where the largest sources of oil recovery are going to be over the next 10 years, it's most likely going to be in deep water. I don't think anybody would dispute that. Transocean is, despite the tragedy, probably one of the best rig operators out there. And so when we think about Rig today, we're thinking about what kind of value can we get from Rig despite what has happened in the Gulf, because we're looking forward over the next 3 to 5 years to try to understand what the economics are going to be. It's
$51 right now. Would you buy in, Robert, now, or no?
We have not bought any shares on this sell down, but let me tell you, we are very, 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 I would say, close to making a decision. It's more likely that we would buy Transocean here at 50 than we would sell it. I can let you know that.
Okay.
One of the exercises we did was simply looking at, if you took all of the Gulf rigs out, say there was no more deepwater drilling in the Gulf, that would impact Transocean's earnings about 25%. That would be a big hit. But that would also price the stock at 7 times earnings. So if you took all the Gulf rigs out, you'd have a stock today that's trading 7 times earnings. That is the global leader in deepwater drilling. That looks pretty interesting to me.
Yeah, you'd be getting it pretty cheap. Robert, and speaking about cheap, some would say that the markets right now are pretty cheap. And if you were a long-term investor, as I know you are, you'd be buying today after the sell-off we saw on Friday. Is that right?
Yeah. Yeah, we've been buying, and we were buying last week. Now let me just make sure that we understand each other. Parts of the market are very, very cheap. When I look at the market, the top 100 stocks in the U.S. stock market, the OEX, the S&P OEX, is as cheap as I've ever seen it. You're probably buying the top 100 stocks at maybe 15 times earnings today and maybe 12 times earnings next year. That is extremely cheap based upon what we think these companies can do over the next 2 to 3 years. On the opposite side, the 600 stocks, the S&P 600, the smallest cap stocks are probably the most expensive that I've seen them in 10 years. They're trading well over 30 times earnings, which would be the highest multiple that I've seen them trade in 10 years.
But then, Robert, just really quickly, how do you stay confident, though, that you are going to get a return in the face of the European crisis, in the face of BP, in the face of bad jobs reports?
Well, this is the challenge of being a long-term investor. If you can get out 3 years to 5 years in your thinking, the S&P 100 may be the easiest place that you will ever make money over the next 3 to 5 years. And for those that think that holding stocks for 3 to 5 years is kind of old-fashioned, let me remind you, a 5-year double is a 15% compounded annual growth rate. A 3-year double is a 26% compounded annual growth rate. So it's hard for me, to think about the next 3 to 6 months, but the next 3 to 5 years, it is the easiest that I've seen it in some time.
Right, it looks pretty attractive. Okay, Robert, good to talk with you. Robert Hagstrom of Legg.